All right, let's talk about the step in the accounting cycle where we've prepared the financial statements and we are now going to close the books, getting them ready for the next accounting period. What that means is that we're going to close temporary accounts. The temporary accounts are your revenues, expenses, and dividends. We're going to close those balances into or transfer them into retained earnings. You can see here, if you will, that for par for the course, this 635 is the balance that's in the general ledger at this point. In other words, this is the beginning balance. It's not what the balance is at May 31. We have to actually make entries to update the retained earnings balance. So what we're going to do is we're going to zero out all our temporary accounts because we want to start the next accounting period with a clean slate so we can track how much our net income is for the next accounting period, and likewise the dividends for our statement of shareholders' equity. So to close out these books, these accounts, to zero them out, we have to look at what the balance is in them and basically do the opposite. So we have a $5,000 credit balance. To close out that revenue account, we're going to debit the sales, that'll make that zero, and transfer that 5,000 into retained earnings. So you'll be debiting sales and crediting retained earnings, such as the following. So now revenues are transferred into retained earnings and our balance is zero, getting us ready so that we can track next period's sales. The next thing you do is you close your expenses. So we have cost of goods sold at $3,500. So I'm going to zero that out by crediting it. And I'll do that for each of the expenses. Okay. Now when you sum up all those, that's a total of $3,995. So we're going to transfer all of these expenses into retained earnings. So when we post that, that'll occur. So we've got the debit of $3,995 and each of these will be credited, making them zero. Lastly, we'll do the same for dividends. It has an $800 debit balance, so we'll zero it out by crediting dividends and debiting retained earnings. And then by posting those, that's what's going to occur. So if you look at the balances here, they're all zero, and that means that we're ready for next accounting period. We can track next year's revenues, expenses, and dividends. Also, if you look here, we now have a retained earnings balance of $840, which is actually what that balance is at May 31. Retained earnings is a permanent account. That $840 will carry forward, and it represents all earnings, past earnings, not just this accounting period, but all the past earnings that have not been paid out in dividends. So take a look at now, if you recall, the retained earnings section of the statement of shareholders' equity. These entries accomplish basically this, and that you had a beginning retained earnings of $635. You closed out net income into retained earnings, in essence, by adding net income to retained earnings, because if you look at this is your total revenues and this is your total expenses. The net of those two is your net income. So we have our beginning retained earnings plus net income of $1,005, which is the same balance on the income statement. And then you subtract the amount you didn't keep of those earnings, dividends, and you get your ending balance of $840. So now we go forward to the next accounting period. We'll carry forward all our asset balances, they're permanent accounts, all our liability accounts, and we'll carry forward our stock accounts as well as this $840 in retained earnings.